Good afternoon, everyone. On behalf of Columbia University, the School of Professional Studies, and our Masters in Wealth Management, it is an honor to welcome you all to this, our 8th Speaker Series event, where from time to time we have industry practitioners and thought leaders come and share with us their thoughts and perspectives on our fast evolving wealth management industry. My name is Philip Hecker. I'm a member of the Advisory Council, and I'll be your moderator today. In terms of the flow of today's discussion, let me tell you the following. This webinar is being recorded, and you can find a replay later on the Columbia Wealth Management website. With respect to our topic today, the US and global economies and markets continue to develop in dynamic ways, and we as wealth managers must find ways to educate and guide our clients in effective and efficient ways. Before I introduce our wonderful panelist who will really bring this topic to life, please allow me a few short words on the new Masters in Wealth Management program, and let me provide you with a brief outlook on the arc of today's conversation. Columbia University's Masters in Wealth Management is a 16-month part-time online program that prepares experienced and aspiring wealth management professionals to meet the disruptive challenges of today's industry. It is the only Masters in Wealth Management offered by an Ivy League institution, and it also provides students with the educational requirements to attain the Certified Financial Planner designation. Should you wish to learn more, simply type Columbia University and Wealth Management into a web browser of your choice. With respect to the arc of today's conversation, first we'll have a panel discussion, getting our guests' thoughts on the economy, markets, and all importantly, the implications for us as wealth managers. Towards the end, we'll open it up for questions from students and faculty. So folks, as we go along, please type your questions into the Q&A box, and we'll be feeding them to our panelists as we go along or towards the end. And with that, it is my great privilege and pleasure to introduce our very special guest for today, who will shed light on this important topic from various angles. We're joined today by Sonders, Chief Investment Strategist at Schwab. Liz is a 20-plus year veteran at Schwab, having joined by way of the US Trust acquisition back in 1999. At Schwab, Lizanne has a range of investment strategy responsibilities, reaching from market and economic analysis to investor education. She is a regular contributor to print and TV media, and she has been named one of the 25 most powerful women in finance by American Banker. I could go on, but perhaps as opposed to speak about Lizanne, let's speak with Lizanne. Lizanne, it's wonderful to have you. Thank you for joining the program.
Oh, my pleasure. Great to be here, Philip. Looking forward to our conversation, and thanks everybody for tuning in.
Likewise, let's perhaps start with some brief icebreaker questions to get to know you a little bit better. Short questions, short answers.
Okay.
Some of your favorite books on investing.
I wish I had time for books. My all-time favorite book on investing is decades and decades and decades old. In fact, it's sitting on my bookshelf right up here, Reminiscences of a Stock Operator, which I actually just cracked back open a year or two ago because it's a nice short read. And it's the one I recommend all the time. And I always remember that book when the sentiment environment gets maybe a little frothy, and we might be in one of those environments now. So it's my go-to book.
Much like you, I enjoy rereading classics from time to time. I have taken more than one random walk down Wall Street.
I think that's up here somewhere too. Oh, yeah.
What are some of the podcasts that you are listening to and are getting value from?
So there's a relatively new Financial Times podcast. Now I can't remember the name of it. I've started to listen to that. I love the Prof G podcast. Scott Galloway is a good friend of mine. Grant Williams has a number of different podcasts. His are always brilliant. But for fun, Smartless.
There we go. I enjoy them all myself. And I would add to that great list the work by Michael Kitces. He has multiple podcasts out there that I think client-centric advisors can get a lot of value
And
from.
we'll be launching one with me sometime in the fall, so stay tuned.
Cannot wait for that session. With respect to travel, many of us are back at it. What are some of your personal favorite travel locations, be it in the US or abroad?
So fortunately, I now live in the two places in the US that historically were my special vacation places because our kids are grown. So Naples, Florida, and Nantucket, Massachusetts. But outside of the US, I'm 100% Norwegian. So anytime I get to go back to the motherland, I love it. One of my two favorite cities are London and actually Cape Town. Probably my favorite family trip was Africa.
Wow, all impressive, all fun. Last icebreaker question for now. If you could invite 3 guests for dinner, alive or dead, anybody, who would it be?
I'm going to now show you to some degree my bias in music, but I think it would probably be Robert Plant, Bono, and Mick Jagger.
Robert Plant, Bono, and Mick Jagger. Wow,
Yes.
what a trio, what a fun dinner. With that, let's pivot over into the meat of today's conversation. As I teed up, we're going to discuss your views on the economy, markets, and implications for wealth managers. But perhaps, given that today in the audience, we have many students that are in the early mid-innings of their careers, many applicants that are potentially interested in developing their own careers. If you don't mind, let's talk about your journey to date. If
Sure.
you don't mind, please share what was your path so far? How have you ended up where you are today?
So I'm a big believer, by the way, in the one of the more fun adages that came from the brilliant philosopher Yogi Berra, which is, when you come to a fork in the road, take it. Coming out of undergraduate school, I had no idea what I wanted to do. I interviewed across a spectrum of industries. This is in 1986. And for lots of reasons, I landed at this company called Zweig Avatar, run by the late, great Marty Zweig. And I went to grad school at night, got my MBA, and was there for 13 years. Started as a grunt, ended up as head of stock selection. But the portfolio management, I was on the bottom up side of things. I just never loved it. I never felt passion for it. I had much more passion for the kind of top down work that Marty brought to the table. And for lots of reasons, I joined US Trust in 1999, one of which was to get exposure to a larger organization where maybe I could hone my top down skills. And 10 months later, Schwab acquired US Trust, and Chuck Schwab himself and our CEO at the time came to New York to meet senior executives at US Trust, sat down with me and said, one of the things we want to do as we expand into wealth management and advice giving is create this role of chief investment strategist. Any interest? And I said, absolutely. And that was 23 years ago. And here I am. So it was a path of learning what I didn't like and then finding passion for something that I was only peripherally involved with in my first 15 years. But now it's my life and I love it.
Wonderful, wonderful to hear. Thank you for sharing that. Let's pivot over to the economy. Of course, as an investment strategist, we want to get your views on the economy first and then the markets. In terms of the economy, the recession of, soft versus hard landing continues to some degree. You've been calling the current cycle, looking at some of your writings, a rolling recession. What do you mean by that? And do you think it's likely to persist?
So to say that this has been a unique cycle is the ultimate understatement. And we started to use that terminology to describe the environment more than a year ago. And not that any of us want to relive the last 3.5 years in this pandemic cycle, but I think it's important to go back to call it spring of 2020, the point at which massive stimulus had kicked in, of course, both on the monetary and fiscal side, in an interest of juicing the economy. While it had the intended effect, the unique aspect to that era, though, was that all that demand, fueled by all the stimulus, was forced to be funneled into the goods side of the economy because we had no access to services. That was the launch for the economy to come out of the COVID recession, but it was very biased on the good side of the economy. That also became the breeding ground of the inflation problem with which we're still dealing, but heavily concentrated on the goods side. Well, fast forward to the more recent period, many of those categories, housing, housing-related, manufacturing, a lot of consumer-oriented goods that were big beneficiaries of lockdown phase, those have gone into recessions, their own recessions. We've also seen disinflation and in many cases outright deflation in those categories within metrics like CPI or PCE. But we've had the later offsetting strength in services, the revenge spending on services. Now, services is a larger employer in the US, so that helps to explain the relative resilience of the labor market. So to me, the debate of recession versus soft landing misses the nuances. To me, best case scenario is not a traditional soft landing because we've already had hard landings in many of those segments of the economy. To me, best case scenario is a continued roll through where if and when services gets hit and it hits the labor market more than what the few cracks we've seen now, that you've got offsetting stability and or strength, like to some degree we've seen in housing, that we can actually have some rolling expansion phases. So I just think we have to look at this cycle for what it is, which is a very unique cycle. I still think, gun to my head, if somebody said, will the NBER ultimately declare an official recession at some point in this cycle? I'd say I'd lean more toward yes than no. But in the meantime, that rolling recession, I think, is the most accurate way to think about this cycle.
No guns in this particular session, but the notion of disaggregating and looking at sectors and dynamics in, the big picture and individually certainly makes sense.
Yep.
In that spirit, the strength of the labor market, and you alluded to it to some degree, is surprising to some. What's driving that in your mind, and can it be maintained in light of the increasingly headline, grabbing layoffs that we're seeing and the lags in Fed policy?
Yeah. So I already touched on one of the factors that has benefited the labor market, which is the later strength in services. And as a much larger employer, I think that's helped to explain resilience. In addition, inflation, although toxic to all of us that have to deal with it on a day-to-day basis and not a friend of Fed policy, it does flatter revenue growth to a significant degree. In fact, in the past year, to the entire degree, where in nominal terms, we've had revenue growth. In real terms, its revenues have been in negative territory. But it's nominal revenues that are most closely linked to hiring and or firing. So it also is one of the reasons why I think we're not literally this moment, but we're sort of in a critical phase here right now because we've got both nominal and real revenue growth coming down. We know that for many companies, labor is their largest cost. Profit margins are already under pressure. So I think especially given that we're in second quarter earnings season, in addition to do the companies beat earnings by how much, those typical metrics we all focus on, I think that focus on top line growth, how much labor costs are coming into the profit margin equation, I think that's a more interesting story to get a sense of where the labor market goes from here. We know there's labor hoarding because of how hard won a lot of the labor that companies have, which is why I think they've been less willing to jump into layoffs really quickly. But what we have seen is a significant shrink in hours worked. That's a leading indicator. We've seen a big move up in layoff announcements. We still have growth in the services area, the areas that were shut down earlier in the pandemic. And that's still where we're seeing growth in employment in areas like leisure and hospitality, even in education and healthcare. But the real hit is coming in areas that had been bigger beneficiaries before. The other really unique thing about this cycle as it relates to the labor market is most downturns in the economy, even if they ultimately end up in a soft landing and not a recession, but any downturn in the economy that results in a weaker labor market, usually layoffs are bottom up. Companies focus on the lower wage and income people first, and then ultimately, particularly if things get bad, it goes up into the supervisory, managerial, C-suite class. This has been turned on its head, where the layoffs to date have been much more top-down in nature, especially in areas like technology and financial services, where it's up the income and wage spectrum into the managerial class, especially among the world of startups. And it's another reason why today's environment across the spectrum of economic data, labor market data is an apple compared to history's, oranges. And I just we have to take into consideration the unique nuances of this cycle, and labor market is one of them.
For sure, we do. One last question on the economy before we pivot over to markets. If I were to hold not a gun, but a flower next to your head,
Thank you.
and ask you, where will the economy go from here? What's your outlook over the next, say, 6 to 18 months? What would be your perspective?
So I did say that I think the bias is still probably towards some version of a formally declared recession, only because of the extremes that we're seeing in things like the plunge in leading indicators, the tightening in what had been the tightening financial conditions, a little bit looser lately, but credit contraction in terms of the willingness, banks' willingness to make loans, which, by the way, had tightened into recession conditions even before the, whatever we want to call it, the banking incidents, I think Jamie Dimon used, as opposed to calling it a crisis. So the whole notion of long and variable lags, I don't think we've passed the expiration date on the lags associated with it, whether it's the inversion of the yield curve, the tightening of lending standards, the severity of monetary tightening that has already kicked in. But I think if we do ultimately get a declared recession, by the way, that always happens down the road. The NBER, simultaneous to the business cycle dating committee within the NBER saying, okay, it's a recession, at that same time, they say, when did it start? And of course, they go back to the peak in the aggregate data that they're tracking, which is why if you're able to take your mind back to the point where you find out a recession has started, or you just look at the data, it actually looks pretty good. It's just that you eventually find out that that was the peak and the move down was sufficient enough to be a recession. So we have to think of the timing. Frankly, I think it would be better for the market, for Fed policy, for the economy, if it happens sooner rather than later, because sooner would probably allow disinflation to really kick in to a more significant degree, and in turn allow the Fed to take their foot off the economic brake. Whereas this notion of a recession being pushed out to, 2024, if we're getting one, sooner is better than later. But I think regardless, my guess is that there's not a lot of dislocations in the economy or a significant amount of leverage in the financial system. So barring some, exogenous shock, it would probably be fairly mild, not to mention the fact that we've already had, as we already talked about, segments of the economy that have had their recessions. I think this one would probably be just more biased on the services side, but hit the labor market. So I think there's still more weakness to come based on the long and variable lags associated with those. I don't think we've rewritten the script on whether an inverted yield curve or a plunge in leading indicators. I'm hearing a lot of it's different this time, and it sounds a lot like what I was hearing in 06 and 07. And it's always a little bit different this time, but there may be an irony to the point at which everybody has jumped off the recession bandwagon and said it's just not going to happen, that's when it happens. I'm never a contrarian just to be a contrarian, but the contrarian in me can't help but muse about the potential for, once everybody just throws in the towel on recession, that's when it hits us.
Look, in any event, regardless of the scenario, regardless if Apple or orange, to use your previous analogy, us as wealth managers must be sensitive to those dynamics and find ways to communicate them in assuring, insightful ways to our clients, thus today's conversation. Let's perhaps pivot at this point from the economy to markets. And as we do that, let me ask folks on the lines, don't be shy. Any questions, comments, thoughts, any areas where you would like Lizanne's perspectives, type them into the Q&A box and we'll relay them as we walk along. Now, when it comes to markets, you have written and spoken about concentration risk that we observe in US equity markets. In particular, I recently saw a great post of yours where, if I recall correctly, the big 8 accounted for 30% or so of, market cap in US equities. What is driving that from your perspective? And does it pose a broader market risk?
So I think there's several things that are driving it. If you were to look at a chart of the bias in terms of performance tied to those, mega cap 7 or 8 names, it really kicked into high gear literally on March 8th, which not coincidentally was the fall of Silicon Valley Bank. So I think there was that initial push that represented where do we go for defense as we think of defense in this cycle. And I think there's still the muscle memory of tech or techie as defense, like was the case during the early part of the pandemic. And of course, that grouping of stocks, which go beyond the tech sector, they're embedded in tech, consumer discretionary, communication services. But of course, we've had the AI kicker on top of it. And then just FOMO and momentum feeds on itself. And you get to the point where the top 10 stocks are more than a third of the S&P now. The top 5 stocks are a quarter of the S&P. And you have similar weights within other cap-weighted indexes like NASDAQ and NASDAQ 100. Interestingly, NASDAQ just last week announced that they are going to do a rebalancing of NASDAQ 100, and that happens early next week. It doesn't look like it would have changed the performance trajectory, but it does have implications. And given how rare it is, it tells you that even one of these index providers is saying, uh-oh. Now, to have cap-weighted indexes performance driven by a smallish handful of stocks, that's happened many times. That's not in and of itself abnormal. What became abnormal in late May, early June was the other stocks performance. So if you went to the very end of May and you looked at the percentage of S&P 500 members that had outperformed the overall index over the prior 60-day period, it was only 15%. And that's an all-time record low, well below even where that metric went to circa 2000. That has since picked back up to 30%. So I think the broadening out is a good thing, but there's probably more that needs to be done. Not that I'm someone that always uses either gun analogies or battlefield. This is purely coincidental, but I think the battlefield analogy that's often used when talking about this subject is a good one, which is when it's only the generals on the front line and the soldiers have not just fallen a bit behind, but have fallen way behind. It's just not as strong a front as when you've got the generals and the soldiers. So I actually think it would be a healthy development if not only we continued to see a broadening out, which we've started to see, but maybe a little bit of give back among that small handful of names. That would help the overall breadth environment. And it might also help what has become a fairly frothy sentiment environment. So I think you'd get that double whammy benefit if we saw some convergence in both directions. But for now, I'll take as a good thing the fact that we are starting to see a bit of a broadening out. There's just more that needs to be done on that front.
You've mentioned investor sentiment. I know from your writings that you are very, very focused on being close and watching, investor sentiment closely. What metrics, what KPIs are you tracking most closely? And what are your thoughts on current dynamics around investor sentiment?
So I track them all. There are a lot of well-known sentiment indicators like American Association of Individual Investors, the weekly AAI poll. I would put that in the bucket of attitudinal measures of sentiment. This just surveys things like Investors Intelligence, which looks at what advisors are saying in things like newsletters. That's also a bit of an attitudinal measure. Maybe it also morphs into behavioral if they're writing about how they actually have their clients' money positioned. Then you have truly behavioral sentiment measures like fund flows, mutual fund flows, ETF flows, the put call ratio within the options market. Then you have indirect sentiment measures like the volatility index, the VIX. So I look at the entire collection, and we had it was sort of mixed for quite some time. And again, not to rehash the past, but it's an interesting context. So if you go back to about a year ago, June of last year, which was when we were 6 months into the bear market, that was the first big move down to lows in June. At that time, you saw record bearishness within attitudinal measures of sentiment, like AAII, record low percentage of bulls, record high percentage of bears. But what was interesting is even within the AAII survey, they also do a monthly survey about equity allocation. And what you had back in June was what investors were saying and what they were doing or had done were diametrically opposed. I'm bearish. I hate the market. Oh, but I haven't done anything yet in terms of my equities. You weren't seeing what I like to call the puke phase, where there's, everybody's dour, and it's also reflected in things like a spike of the put call ratio and massive outflows. Fast forward to October, there was a little bit more of that puke phase. You had more of a connection between attitudinal measures of sentiment, behavioral measures of sentiment. And what was interesting about that time is the indexes in October took out the prior June low, but under the surface, breadth was much better. So you had a positive trifecta in October of last year of an oversold market technically, sentiment across the board washed out, and breadth improving under the surface. Now we have breadth improving, but we have an overbought market, and it could stay overbought for a really long period of time, like many of us learned in the late 1990s. So I think that sentiment, I wouldn't mind seeing it come in a little bit. The last thing I'd say, though, about sentiment is even at extremes of either frothiness and optimism or despair, there's nothing even close to perfect about what that means as a timing indicator. Sentiment can stay frothy and stay there for years. Alan Greenspan made the irrational exuberance comment in 1996, and the bull market lasted until 2000. So I think it's an important thing to have as a tool in your sort of overall toolbox to assess the environment, but it certainly doesn't serve as anything relating to some moment in time timing indicator. It really just represents when sentiment gets frothy, the risk, to the extent there's some sort of negative catalyst, probably means there's a bit more downside because everybody has shifted sort of to one side of the boat.
Interesting to me, Lizanne, how you as an investment strategist weave together different disciplines and points of view, fundamental analysis, technical analysis, investor sentiment, and other perspectives that you marshal to get to a comprehensive composite picture. I think we as wealth managers can take a lot away from that. Weaving those disciplines, those view of assessing markets and securities together into one comprehensive perspective can be beneficial. Now, let's turn to the all-time classics. You as an investment strategist, we would be remiss to not briefly get your take on the three classics of corporate earnings, profit margins, and valuations. Where do you see those going?
So I think I'm going to say it again, this unique environment. The consensus right now, we're obviously in second quarter reporting season, and this data is all S&P 500 related. And expectation is that we'll have a negative quarter for earnings to the tune of 7 to 8%. But we're early enough in the season that number will inevitably change. And now the consensus for third quarter is move back into slight positive territory and then back into double-digit territory in the fourth quarter. I wouldn't put a lot of credence in those forward estimates, not because I think analysts are suddenly clueless about what the earnings trajectory is going to be, but what happened during the worst part of the pandemic, and I'm not sure we're fully out of this phase, is that a record percentage of companies didn't just guide down the analysts covering their stocks, they withdrew guidance altogether and said, we have no idea. We're not going to attempt to guide you to some, dollars, cents quarterly number. Frankly, even though more companies are now providing guidance again, I think many of them, without necessarily admitting it, took the pandemic as an excuse to back away from the kind of precise quarterly guidance that has allowed the forward estimates to be in the past relatively accurate, or at least within some range of what ultimately happens. Now, I think what's happening is analysts are really not doing much with the out quarter estimates, other than maybe one quarter beyond the reporting season that you're in the midst of, where they're hearing from their companies, they can kind of shift estimates out one quarter, but they're sort of leaving. That's why you're not seeing much movement in estimates for the fourth quarter. You've started to see movement for the third quarter now that we're reporting second quarter, and those have been trending down. So, which in turn, now we get to valuation is tough, because the most common metric is forward PE, and it's just a question of the validity of that forward E, when I'm not sure we can rely on that consensus as much. I think there's still some more downside to second half of the year estimates, in part because of what's most highly correlated to earnings with a lag. And two of the things most highly correlated are PMIs and lending standards. And both of those suggest that there's still more downside in earnings. But I don't think we have a significant earnings problem here. In fact, all you generally need to help the market is a stabilization. This idea that the market only does well when earnings are booming suggests you haven't looked at the data. So what's interesting about earnings and the stock market is, maybe no surprise, the worst performance for the stock market has come when earnings are down more than 20% year over year. That's sort of a duh. That's serious recession type compression in earnings. But the best performance for the S&P has come when earnings are down between negative 20% and only up 5%. The second worst performance for equities is when earnings are up more than 20%. And the point of all of this is that one of the most important things to understand when trying to connect the dots between what's going on in the earnings environment or what's going on with economic data and connecting the dot to the market is, it's human nature for us to think about earnings, retail sales, job growth, whatever the metric is, in good versus bad or strong versus weak terms, level analysis. But better or worse matters more than good or bad. And I think it's that rate of change. And what happens is, yes, the compression of earnings to more than minus 20%, deep recession type territory, that's terrible for the market. But it's the move out of that zone that's the launch point for the market. By the time you get to strong, more than 20% earnings growth, you've basically had most of the run. And now the market says, all right, better or worse. It's going to start to get worse. So I think that's the nuance that is missed. I will say, though, that this entire move since October has been all multiple expansion. There's been no E. That's the complete opposite of what happened in the first half of last year, where it was all multiple compression. You had earnings growing. This is now all multiple expansion with no growth in E, further suggesting that we're going to need to see stabilization in earnings so that the ability for earnings to catch up to multiples is not pushed too far into the future. It's something near term. That's a potential risk factor. When I talked about potential negative catalysts with frothy sentiment, I would put that on the list of possible negative catalysts.
Got it. Super helpful. Let's shift here. We've discussed, economy. We've discussed markets. Let's tease out and focus on the all-important implications for us as wealth manager. My first question was prepared and is reacting to a great input that came from Maria out on the line. She's wondering, let's put yourself in the shoes of a wealth manager interacting with a perhaps less savvy, less educated, less sophisticated person on the investments front. Which indicators do you suggest one focuses on in the discussion? What are fundamental discussion points? to educate, to guide budding investors when it comes to markets investing today?
Great question. We could spend more than an entire hour on that, but
It's
let me.
hard to be simple.
It is hard to be simple. So I think an understanding of both how economic cycles unfold and how market cycles unfold and the relationship between the two is essential. And that brings up this idea of what leads, what's coincident, what is lagging. And when it comes to economic data and the tie into the stock market, given that the stock market is generally a leading indicator, I think a keen understanding of what indicators fall in the leading bucket, which ones fall in the coincident bucket, and which ones fall in the lagging bucket. And I won't go through all of them now. That would take forever. But given that the equity market is a leading indicator, I think one of the mistakes that investors will make, especially newer investors, is they might, without realizing it, tie their view on the equity market to their view on, say, the unemployment rate. Well, you're comparing a leading indicator to a lagging indicator, and the unemployment rate is not going to help you in terms of what's going on in the equity market. And it goes back to the better or worse matters more than good or bad. In terms of what drives the market cycle, I think probably the best thing ever said about a full stock market cycle was said by the late, great Sir John Templeton. It's probably his most famous quote, which is, bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. I think there's not a better descriptor for a full equity market cycle. And notice there's not a single word in there that has anything to do with interest rates, inflation, earnings, PE ratios. It's all about emotion and sentiment. And I think understanding that that's really what is not just driving market cycles, but driving economic cycles. It's animal spirits, it's fear and greed, and those emotions come into play in the economy, that come into play. So you have to have a big dose of focus on the psychology of economies and markets to be able to truly understand what is happening. And I think there are times where people are too sort of quant and numbers focused without taking a step back and incorporating the psychological aspect of things. And the other thing I think is really important, especially when talking to sort of novice investors, is especially wealth managers who are dealing with a wide variety of clients, of their investors, in terms of time horizon and age and past experience and risk tolerance. Is one of the things I say is too often there's this simplistic tie between risk tolerance and time horizon. I have a long time horizon, therefore I should take a lot of risk, or I have a short time horizon, therefore I shouldn't take a lot of risk. But that isn't always a perfect connection. You could say, I'm not retiring for another 30 years, but if you're going to freak out and panic and sell everything at the first 10 or 15% drop in your portfolio, I don't care how long your time horizon is, you are not a risk tolerant investor. And I think trying to gauge whether there's a wide or a narrow gap between someone's financial risk tolerance and their emotional risk tolerance is probably one of the key things to try to do. Unfortunately, a lot of investors figure out the hard way that there's a bigger gap than what they thought because panic kicks in. And then the last thing I'd say is, especially in this environment, just remember FOMO is not an investing strategy, nor is panic. Investing is not about tops and bottoms and moments in time of get in, get out. It's a disciplined process over time. And I think the media has done a disservice in focusing more on the get in, get out, the year-end price target, the bombastic calls, when I don't know any successful investor that has gotten there by making the all in, all out, get in, get out, timing tops and bottoms. It's a disciplined process over time. And that's what we have to continue to kind of pound home to investors broadly, certainly if they're our clients.
Liz, I very much like what you did there. You tied the investments dialogue to the all-important goals, objectives, time horizon, and risk tolerance and behavioral characteristics of that client.
Right.
One cannot make good investment recommendations without the all-important context from 100%. An individual investor point of view.
Which, by the way, Philip, is why when people say, so what are you telling your clients to do? What exposure are you suggesting? And first of all, we have $8 trillion of client assets, but I always say, well, who's the investor? Share answers with numbers or percentages as if there's some cookie cutter approach that's applicable to all investors. So I'm glad you summarized with that very important point.
Your 8 trillion plus of assets at Schwab come in different shapes, sizes, and stripes. You've got active, you've got passive, you've got self-directed, you've got hybrid, you've got outright managed money. What are some observations you may have and are able to share top down? How do these pools of money behave during different parts of the cycle? What are lessons learned perhaps there for us as wealth managers?
Well, one kind of comparison that I think has come into brighter light these days is the whole active versus passive. We know that passive has been all the rage and has been manifested with the massive growth in mutual funds and other index oriented funds. And it's not so much been at the expense of active, but the backdrop market environment, which I'll get to in a second in terms of the details therein, has also been to the benefit of passive. And then you add in the cost differential based on fees, et cetera. You've just had this major shift toward passive, and to some degree with justification, investors saying, why would I bother with active? It's more expensive. And active hasn't really operated on a level playing field with passive, I think, until recently. So the backdrop that I think has been a force at play and why passive has done so much better than active is sort of the post-global financial crisis era of extremely easy monetary policy, 0% interest rates, ballooning balance sheet. And that's not just in the United States, that's everywhere. In fact, it's not ZIRP. In other places, it became NIRP, negative interest rate policy. And that had the effect of capital misallocation and kind of mucking with price discovery, ample liquidity at low cost. And it just wasn't to the benefit of active, especially given that correlations were high, dispersion was low. Now we've had this most aggressive tightening cycle in 40 years. We have the return of the risk-free rate. There is now price discovery. Correlations have come down. Dispersion has gone up. Fundamentals are reconnecting to prices. And all else equal, which is always important to stay in this business, not that now it's going to be active's day in the sun and they're going to trounce passive like was the case in the opposite direction, but I think the playing field is a bit more level now for active. But we've always said you can have both in portfolios. You can have active managers and passive managers. And we're not just talking on the equity side of things, but on the fixed income side of things. The other thing I'd say is we've really kind of democratized investing. Individual investors now have much broader access to asset classes that go well beyond the traditional stocks, bonds, and cash at low fees and cheap entry points. So it allows for individual investors to almost take an endowment-like approach to how their money is managed, either by an outside money manager or an advisor, or if they're doing it themselves. And I think the benefit of diversification we all know, but the ability to actually be diversified within and across asset classes has never been broader than it is right now. And I think we need to avail ourselves of that.
Concur with your framing. It shouldn't be thought of as active versus passive. It's an and, not an or.
100%.
And I hope you're right that the climate for active is improving. I cannot wait to read the SPIVA studies in years to come and see numerically if, where, and how active does better.
By the way, the percentage of active managers that outperformed their benchmark last year was the highest since 2005, which I'll remind you was pre this post-global financial crisis era. So we're starting to get some data points that corroborate that broader view.
Of arguably low levels.
Right. Oh, yeah, for sure.
Okay, excellent. We're right on time. We're about to pivot over into some questions that the great audience has been feeding us in here. Okay. Grateful for that, guys on the lines, and folks, keep those, questions coming. The first question might be perceived as a bit of a challenging one for you, but it's not meant in that spirit.
Okay.
We have an audience member wondering the following. Look, predictions are hard. We all acknowledge that, in particular when they pertain to the future. Having said that, if a wealth manager or investor were to print out the market outlooks from all the big houses over the past several years and look with the benefit of hindsight, which is 2020, to what degree did those predictions actually pan out? I think we can all acknowledge we would encounter a very mixed picture, if you will.
No question about it.
What are some lessons learned from your perspective? You know, looking back in the rearview mirror, where have you and your peers erred, and why could that be? Are there systematic things at work that we can all learn from?
So let me do the important thing first, which is differentiate what we do at Schwab and the nature of our client base being 8 trillion, which is massive. We're the biggest, but for all intents and purposes, all individual investors, no institutions. So, and that's in contrast to whether it's the Morgan Stanleys, Goldman Sachs's, JP Morgan's, you name it, where for the most part, when gauging the success or lack thereof on the part of their strategists is by comparing year-end price target. That's kind of the metric. First of all, I think that that's a ridiculous exercise. The year-end price target, I don't see of any value. And what's really important is not just saying, okay, once we get to the end of the year, who was closest to the right year-end target, but maybe importantly, well, how many times did they revise it as the year went on? And yes, it's a clean way to compare strategists or firms, but I'm not sure what value the year-end price target. I think it's what happens along the way and the perspective that helps individual investors that matter. But I will say that to the extent that somebody advising institutions that is operating with a shorter time horizon and making more definitive market calls, whether it's via the metric of year-end price target or, you know, I think a 10% correction is coming in the next couple of months. That market timing analysis with a little precision, I think those on the more pessimistic end of the spectrum had perfect justification for that, given no earnings growth, top line growth being solely driven by inflation, the most aggressive monetary policy tightening cycle in 40 years, a severely inverted yield curve, a 17-month plunge in the leading indicators that has never happened other than in recession, and then concerns about things like FOMO and frothy sentiment. You know, a cautious case has been a pretty easy case. I think what was wrong about that is that, to go back to another old adage, you know, the market likes to climb a wall of worry. And there have been a lot of bricks in that wall of worry. And I think that's what was probably missing in the much more cautious perspectives out there, is was precisely the backdrop that sort of fed the rally. Was the market, as it often does, has climbed this wall of worry, and that's the easiest way to think about the pessimists and what they got wrong.
Got it. Helpful perspective. Thanks for that, Kenda, and sharing that. On to a next audience question here. Yanis is wondering the following. Oftentimes one hears the phrase, the market has priced news X or policy Y in. How, from your perspective, can one determine if indeed certain news are being priced in, or better yet, have not been, you know, fully priced in yet? How can one think about that important but difficult question?
Very broadly, and that is a subjective analysis. Yes, there are really quant-oriented people, firms, systems, programs, whatever you want to call it, that will do intense quant analysis on fair value using, you know, the discount rate and discounted future cash flows and all of those things, or technicians that are very much reliant on moving averages and advanced decline and relative strength, overbought, oversold. But, you know, if there was one way to approach the market and know definitively, all right, none of the bad news is priced in. All of the good news is priced in. The inevitable turn in either direction is coming. Wouldn't this be really easy? And it's just not, because there's so much subjectivity. I think the whole fair value with regard to valuation, that seems to be the most concrete way we can assess whether the data, the news, is priced in. The problem is that even though valuation, whatever metric, whether it's PE ratio, forward PE, trailing PE, Shiller's cyclically adjusted PE, or other valuation metrics, the Fed model, the Buffett model, Tobin's Q, rule of 20, equity risk premiums, they're all quantifiable. They have quantifiable components, and we can plug them into a model or just look at them in the context of history and look at the background conditions that might define whether multiples have historically been on the high end of the spectrum, the low end of the spectrum, all of those things. But even valuation, which is very quantifiable, is as much a sentiment indicator as anything else, or maybe an indicator of sentiment. So whether it's technical analysis, whether it's valuation analysis, whether it's cycle analysis or seasonals or election, cycle tendencies, we still have, it's still subjective, and we never know at any point in time how much of the good news or bad news that's right in front of us is priced in, because you can go through extended periods where all the bad news is priced in, but sentiment stays dour for an extended period of time. The extended period tends to be more elongated when you are in extreme optimism territory, obviously. The extreme pessimism that manifests itself in everything, sentiment getting washed out, majorly oversold conditions, deep discount in terms of valuation. Frankly, those are sort of easier calls, if you want to call it that, than the other end of the spectrum, because the period of which things seem out of whack, everything is too negative, and then some of the negative news is priced in, those eras tend to be much more condensed. So I think if you were going to try to call tops and bottoms, I think calling the bottom is easier than calling the top. That's what I would say, but it's impossible to do, which is why we don't try to.
Very good guidance. And as a friendly reminder, for good trade, one always needs to make two calls, in and out, bottom and top, adding to the complexity.
Neither get in nor get out as an investing strategy. That's just gambling on two moments in time. And that's not, investing should be a disciplined process over time, not about one or two moments in time.
Reminds me of the great and late Jack Bogle, just stand there, do nothing.
That's often, or not doing something, but the discipline of rebalancing is such a beautiful discipline, because your portfolio tells you when it's time to do something, and it forces investors to go against the emotional grain. And it forces us to do a version of buy low, sell high, which is add low, trim high. When left to our own devices, we end up doing the opposite. So these disciplines, which are maybe boring to talk about, more boring than, I think we're going to get a 15% correction in the next 2 weeks, but that's what really matters in terms of long-term success.
And adds a lot of value. So does tax harvesting. So there are things we as wealth managers can do to add value on multiple
100%.
dimensions. No question. I'm being conscious of time. We have one more question from the audience. We actually have multiple questions around AI, machine learning, which we hear a lot about right now in wealth management and the economy at large. Briefly, your perspectives on the impact, good or bad, that AI and machine learning will have on the economy at large, thinking layoffs of lower skilled workers and so on. And for us in wealth management, we as wealth managers, how should we think about the emergence of AI machine learning?
So caveat, I'm not an expert, and I wish I heard that from more people who wax philosophical or opine on AI and how transformative it's going to be, either on the good side of things or the bad side of things, where the reality is we don't know. And it's probably some combination. I think it's a game changer. We know components thereof, like ChatGPT, in terms of adoption, have been more rapid than anything we have seen in the past. But we also have players within the space, including CEOs of companies directly in AI, that have literally gone in front of Congress us and said, please regulate us. And that ties to the grave concerns that exist, not just by kind of the fringe players out there that are always going to talk about the world is imminently coming to an end and will be gone by next Tuesday, but I remember reading a BCA report a couple of months ago, bank credit analysts. They've been around for decades, brilliant research, not known for being hyperbolic by any means. And they did a long form, 40 or 50 pages on AI. But what was most eye-catching was one of the few bullets kind of on the front page of this longer form report was there's more than a 50% chance by the middle of this century, AI will wipe out the entire human race. Needless to say, I had to read it twice. And I've seen comments like that from other places that are not known for being hyperbolic. And I think that's part of the reason why there's as much focus on where could this really go off the rails beyond, does it replace humans in certain areas, but whether it's access to data or nuclear codes, all of the horrible things we could think about. So when I think about black swans, it's hard not to think that future black swans, and there always will be them, could have sort of AI associated with it. That said, it's transformative in terms of changing the nature of how we work. I don't ever worry about a major advancement in innovation or technology as a secular game changer in terms of the workforce. I think we always adapt. And right now at this stage, we know that a lot of things that people have done can now be done via the broad technology of AI, freeing people up maybe for more creative outlets. So there is creative destruction, but I don't think it ultimately means the destruction of the workforce. It's just things shift and opportunities present themselves that weren't there before. And we're very adaptive there, but we have to consider the uglier side of this, and anyone trying to put their finger on what that looks like. But it's a reason why there's so much focus on how do we regulate this? What does it look like in terms of the providers of the technology to industry organizations, as well as what government regulation might look like? So it's fascinating, but scary as well.
Lizanne, I'm with you. I think we need to think about the potential downside scenarios, much as you point us to, but also think about the upside potential.
Huge.
And I'm reminded of the story of the ATM. When that emerged many, many decades ago, many smart, informed people predicted the demise of the tellers, bank employees, and, branch on your corner. Decades later, we still have roughly the same amount of bank branches and the same amount of people working in those branches. But to your point, what they did, how they added value has evolved. We may see similar dynamics at work when it comes to AI. We could go on and on and on. Being conscious of time, Lizanne, I want to wrap at this point in time. To our audience, yes, the book recommendations and links to Spiva and other resources will be included in the show notes on the Columbia website. We hope that you enjoyed today's discussion as much as I did. A lot of food for thought, a lot of valuable perspectives, a lot of invaluable tips we were able to glean from you, Lizanne. It's been a true pleasure. Thank you for your time, wisdom, and perspectives. Going forward, consider yourself a friend of Columbia. Next time in New York City, come and say hello on campus.
Would love
With that,
to.
thank you.
Thank you.
And goodbye, everyone. Have a great rest of your day.